He says, we are beginning to see good signs in the economy, but still some distance to stably and sustainably hit the inflation target. That's been reflected by the Japanese government, that they raised their overall economic view for the first time since July 2022. A lot of the components in that getting an upgrade in language, which again keeps this little snowball rolling that things are picking up in Japan for the moment anyway. Over to the RBNZ, and Governor Orr said rates are restrictive and well above neutral. Riksbank's Floden said inflation isn't going to disappear by itself. Monetary policy needs to be restrictive for some time ahead. Again, reflecting language that we're going to be hearing from a lot of central banks about getting rates up, getting to a peak, and then keeping them there for a long time. And we're all going to be trading the expectations for how long they keep rates up before the cuts come. ECB's F.A.C.E says ECB must still raise interest rates more. ECB's De Guindos says headline inflation will decline rapidly, but services inflation is the most worrying element of the core. And we know that from the PMIs, where we're seeing in nearly all cases weaker manufacturing but stronger services, and with that is coming stronger inflation in prices in the service sector, and that's making up a big chunk of the core there. Now, data from Germany, and confirming that Q1 wasn't all that it was cracked up to be. Final numbers there, down 0.3 quarter on quarter, year on year down 0.2. We got a bit of a surprise on the flash numbers when that data came out. It was expected to rise and it came in lower. It was expected to improve in the final numbers year on year and on the quarter, but it didn't. So Germany potentially in recession there, as had been well, not predicted by the Bundesbank, who saw modest economic growth, but the German government revised down its forecasts. So we'll see whether there's going to be a pickup in Q2. The IFO yesterday mentioned they see the potential for a bit of stagflation in Germany in Q2. Spain got some decent PPI news, a negative number on the month, which for some reason isn't showing there. The year-on-year number down a chunk, minus 4.5. That's going to be some good news for the ECB in terms of inflation coming down, particularly in Spain. We're now seeing negative numbers, as mentioned, on the year-on-years. Month on month, it came in at minus 2% as well. So all metrics pointing south for that. Our old mate Bailey was up yesterday afternoon. I'm going to call him Bullshit Bailey from now on, because he just basically spoke a load of rubbish yesterday. So one of the things he said is our projections show the government will meet its inflation target this year. Now, what's crazy about this is that we've got the Bank of England now forecasting what government forecasts are going to do, and neither can forecast the sun coming up in the morning. So complete load of crap from there, as far as who's forecasting what. Sticking to the forecast, he said, we will not speculate on where April inflation data leaves us in terms of forecasts. About a third of rate rises have hit the economy now. And again, he said, our projections show the government will meet its inflation target. And then he added, this is not a good era for forecasting. So he's forecasting the government, and then he's saying it's not a good era for forecasting. You know what I think about forecasts. What do you think about forecasts, Dale?
Anything beyond the month forward is rubbish.
Absolutely.
I mean, I don't know.
Prove that point in a moment.
Yeah. I don't know what to say, man. And seriously, I hear this comment, central bankers saying, oh, we've been surprised by
speaking inflation has been. Oh, hold on. My headphones keep switching off. Sorry, give me 1 second.
Yeah, no worries, mate.
I need to change them. I need to get.
Okay, so central bank is saying, "Oh, we're surprised by how sticky inflation is," and or initially they're saying we're surprised by how fast inflation is going up. We didn't think it's going to go. They're surprised all the time, and seriously, it's frustrating because they try to forecast, they try to anticipate, and they are doing pretty much the opposite of what they should be doing, or they get it wrong every time. So, my view on their forecasts is they're rubbish.
Yeah. And well, as I say, my view on forecasts, and I'm going to give it again because since the inflation data, every Tom, Dick, and Harriet has been out changing their forecast for the Bank of England. Citi now expects 2 further hikes from the BOE rather than 1, and now they don't see any cuts in November, where previously they did see a cut. That's following the inflation data. Good old Nomura, the big clickbaiters, they've now raised their expectation for the peak rate for the BOE to 5.25% by September 23. They previously saw a 4.75% peak, so they've hiked up 50 pips on that estimate, and this is for September. Bank of America now see 25 pip hikes in June, August, and September. They've also raised their terminal rate to 5.25 from 4.75. Deutsche Bank now expects them to deliver 25 pips hikes in August and September, so 2 hikes from them. And apparently money markets have fully priced in 100 basis points of BOE hikes by December. So all the tea leaves being read again, all the prior forecasts getting ripped up and thrown in the bin, as they usually are. Again, this lot, they couldn't forecast the sun coming up in the morning. All it'll take is the next CPI report to go the other way and see big soft numbers, and they'll all be reversing those forecasts. What does it mean for us trading it? Well, it just shows you that the market may be getting a bit over expectant from the Bank of England now. It's the usual boat running. So they're all running the other way. They were all less hawkish before the CPI data. Now they get into extreme hawkish in the CPI data. So what that means for us is going into the next piece of data or the Bank of England, we know potentially which way the market is leaning. If we know that, we know where the biggest risk lies for us trading. If everyone's expecting hikes and they don't hike, you're going to see a bigger reaction, downside move to the pound than an upside move if they do hike. This is why, as much as I take the mick out of these forecasts, I want to know what they are, because I want to know what the market is thinking, so that when we get to those big trading moments, I know where my risk is, and I know whether I want to be on the other side of that trade to where everyone else is. So we may laugh and joke, but it does serve an important thing, keeping an eye on those forecasts. Over to the Fed. Waller says they don't want to halt hikes until it's clear inflation is tamed. Whether the Fed hikes or skips in June is going to hinge on the data. Is concerned about a lack of progress on core inflation. More loosening of the very tight labour market needs to be seen to help take the heat off high inflation. Does not expect data in the next couple of months to make it clear whether the terminal interest rate has been reached. So a little bit of fence sitting there from him. Fed's Bostic, we've heard from him quite often beginning of the week, says the best case is the Fed won't mull a rate cut until well into 2024. Fed minutes were out overnight or last night. No real shocks coming out of that, nothing we didn't know already. They showed officials are pretty split on support for more hikes. They wanted to stress the data dependent approach and make clear that cuts are unlikely. Officials said they saw a timely debt limit as essential, so getting that resolved as essential. I still think that may be a factor behind what they do in June. If we do have a resolution, I think they're clear for a hike if that's what they want to do. If we have hit the debt limit, I think that might tip them into a pause if they're not there already. Something else to keep an eye on: Fitch has placed the US AAA rating on negative watch, saying that the US AAA may be cut based on all this debt stuff. It still expects a resolution to the debt limit before the X date. Now, why is this important? Well, if you get your rating cut, investors again charge a premium for borrowing money or lending you money. So it can push up costs for the US. It's not going to be, the end of the world if they cut the rating based on heading towards the debt ceiling. Obviously, a default is a different matter altogether, but we're not expecting that anyway. But it just could cause a little bit of waves because, some investors also, they only want to hold investments that are AAA rated. So if you're now down to AA plus or whatever they call it, investors will exit out of some of those investments and go into others that are AAA. So it can cause some flows getting moved around. So if that happens, keep an eye on that. But it'll be a secondary move because that will mean we've probably hit the debt limit and we're at an impasse and we're facing shutdowns. And on the good old debt stuff, I love all this. US House Speaker McCarthy said they're sending negotiators to the White House to finish things. There's a number of places we are still far apart. I think we can make progress today. This is yesterday's headlines. We can get to yes on a debt deal. Later on, he came out and spoke to reporters saying they could get a debt agreement in principle this weekend. And apparently all the people involved in both houses have been put on. They've been told they can go home for the long weekend because it's a half day tomorrow afternoon. But they're put on notice, 24-hour notice, that they may be required to vote on the deals or whatever. So a little bit more positive on that front from the comments. We'll see what we get later on today. As we know, it could all change in a heartbeat. Do you think we're edging closer still?
Closer to committing suicide from this stupid thing. No, I mean, I don't know how far they want to take it, but I've said before many times, this really, no way any of these politicians want to have it on their watch that they that the US defaults on debt. I mean, could we get another government shutdown like 10 years ago? Yeah, we could. Which, again, I don't see what purpose it serves apart from trying to blackmail. One side tries to blackmail the other to get what they want, but one side says we have to cut spending and the other side says no, we just raise the limit and we keep going. So cutting spending is actually the right thing to do, but how do you do it without inflicting tremendous political damage? You can't, and that's the question that all governments face, not just in the US, and all politicians face. How do we to effectively buy votes without creating a problem to the economy? Well, you can't. You will eventually pay the price, which is a weaker currency, and it's and I personally don't see, with $1 trillion plus deficit every year, how they can plug that gap without borrowing more. I really don't see how they're going to do it. So my opinion is still the same. They're going to raise that limit. Maybe they do some spending cuts here and there, but really overall, they're probably going to increase spending over the next years. So cut spending and increase the defense budget at the same time. Yeah. I mean, it's a tricky situation. I think it's going to get resolved. When? I don't know. I mean, if I knew, I would be a billionaire. So I think the risk of a default on debt is totally exaggerated. I think it's less than it's 1%. I really do. So I look at these bills that expire in the end of June, and they've gone up from, what was it, 4.5%? They're up to God knows how much now. I think that's an incredible opportunity to get some really, really nice yield. Yes, you have the danger of getting zero back, but I think that's a 1% chance. So,
I agree with that. And, we've got this potential 1st of June deadline now, which is only taking into account the bank holiday, it's only 5 days away. So they are running out of time to get this done. This X date, 1st of June, is not set in stone. It might run to something like the 8th. So we could get a bit of the 11th hour might be the 31st of May, but that 11th hour might get pushed forward by a few days if they run it to the 8th of June. It's sometime in that period. I don't think they can nail it down. It's when they actually run out of cash. That'll be the X date. But yeah, they've got only got a few more days to go, so we are looking to get there. But based on these comments from last night, I was 70-30 on a deal getting done. I'm probably more 75-80% on a deal getting done based on that comments as we.
I agree on that. I do agree.
So, as we say, that could all change. We could get some comments later on saying that they're still far apart. No one's willing to budge, and we'll go back into reverse. But anyway, we can only trade what we know when we get it. What isn't looking so hot is that Russia's Shoigu said that the decision to retaliate in the nuclear sphere comes amid a dramatic escalation of threats on the western borders. This is all to do with that incursion or by Ukrainian saboteurs, as Russia put it, in Belgorod.
Saboteurs, wow.
Saboteurs, yeah. And, apparently Russia put up a picture of a couple of Humvees that got captured or from this failed incursion, or what they're calling it, and it's been completely picked apart by people saying it's been staged. These Humvees have been loaded off a flatbed lorry and put into this ditch because there's no dirt on the tires, there's no dirt on the bumper.
Oh dear.
It's a big old mess, but take it as you will. But Russia just up in the rhetoric there, bringing nukes back into the conversation. Let's hope we don't go there. Otherwise, no one will give a monkeys about the debt ceiling in the US. We'll all be piles of ashes on the ground. Anyway, and I'll be out my trades definitely by then. Right. I don't know if you've got any headlines or anything you want to chuck in still before we crack into the charts.
Not really. It's been relatively quiet. I mean, the big data wise was German GDP today, which came in at -0.3, expected cut to rise from -0.4 to -0.1. So it's not looking good. The GfK number also slightly worse than expected. So I think the situation is we're getting to the point where we're going to be pausing pretty much everywhere. And no matter how the central banks talk, the hawkish talk, as long as inflation is not really stubbornly high, I think the UK is probably one standing out in terms of inflation that is higher than the rest. I think the Fed's going to be pausing, and the question is pause and hike again. I think once they pause, it's probably done. So that's where we're heading, I think, and inflation continues to creep down. And the other thing I wanted to say is this: let's say you have economic environment where the price of goods is X, everything is flowing, everything is fine, and then you get a black swan event. Let's say Russia invades Ukraine, and then everything becomes more expensive, and oil goes up, the price of everything goes up, corn, wheat, everything. So all the products that you generate become more expensive. At some point, you get to a new equilibrium level where things used to cost, I don't know, $1 per kilo to bring in. Now it costs $2. But you do get to an equilibrium. Once you get to that point, inflation goes down to zero. Is that good? Of course not. But that's, I think, all else unchanged, and the central bankers know this, all else unchanged, inflation will creep down to zero. Why? Because the jump in inflation was not because, hey, everything's going great, everybody has jobs. Okay, they do. Everybody has loads of disposable income. They're buying everything left, right, and center. No, the opposite is happening. Disposable income is dropping. People are borrowing more and more on the credit cards to buy stuff. So
Yeah.
if the case was that everything is going up because demand is really booming because the world is great, then yes, inflation is going to stay higher for longer. But we've had a black swan event that shot everything higher. At some point, the markets find an equilibrium with the new supply chain situation, with everything, and then inflation goes down. I'm not going to say down to zero, but you know what I mean. So
Yeah.
we have to keep in mind that this is the end game as months go by, and every month that goes by, we subtract a high inflation month, we add in a low inflation month. So that's going to keep dropping and dropping and dropping. Just need to keep that in our minds. And this is what unfortunately, this is what the central banks are looking at. As if inflation goes down to 2% tomorrow, they're going to say, oh, amazing success, we've made it. It was us. No, it wasn't you. Anyway, sorry, I tend to rant a little bit, but yeah, just wanted to say that one more time. Have I been disconnected?
No, you're here, mate.
Oh,
You're
okay,
here, mate.
okay, sorry. Sorry.
You're
By the way,
absolutely right.
we have Greg as well here, so I'm sure
Yeah,
he's
Greg is here.
waiting
I'm
to.
going to bring him in
Yeah.
in a moment. But you're right. We say when if you look at it in the context of mathematical terms, let's say your $1 a kilo, whatever the example it uses now, $2. If it's taken a year to go up 100%, so it's gone up 10% 1 month, 9%, blah 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 blah, and a year later it's 100%. If it goes down 50%, if you see inflation of minus 50% in 2-3 months, and then it stops, you say, well, we've seen minus 50%, great. Well, you're still 50 cents higher than you were the prior year when things were a buck. Now your equilibrium is $1.50, even with minus 50% inflation. So, like you say, we're not going to be getting down unless we see deflationary style numbers coming in, i.e. negative CPR readings. We're just going to be sitting at higher levels than we were a year, 18 months ago. And things aren't going to go back to the way it is, the way it was then. And everyone just has to hope that your wages catch up with it to match that equilibrium. But that's the way it works, unfortunately.
Yep.
Anyway, quick look at the price. I'll just run through a couple, then I'll bring in our Wizard of Waves, who's going to wow us with his charts and stuff. Already mentioned dollar China, keep an eye on this one. The pullbacks have been very limited. The close support is really probably around this 705 area, 0405 area at the moment. I'm still looking to see if we're going to move down to 703s. If it holds, I want to try and add back into my long position for another run, but it depends where we come from. If we come from here, I'll be inclined. If we've had a rally up to 710, 712, and then pull back to there, I might be less inclined because that'll be quite a big move and probably some news behind it. So it's all about where we come from if we make that test. Aussie dollar. A lot of people in our room were looking at this yesterday for a bit of a long down here. This was an area, as you know, I've been looking at for a while down at this fib. It's been a prior traffic area, as you can see, going back to this period in 2022, late 2022. I was looking at maybe getting out all my shorts and turning long. I've kept my shorts. I took a bit off into this level, 50. And I waited until maybe the test of 20s because I thought that might be a bit stronger than starting at in the 40s, and that actually proved to be the case. But at the moment, we're not bouncing very strongly. We're not getting back up through this 45. So we've got a bit of a decision to make here. Are we going to get back up through there, or are we going to go through the 20s? At the moment, I would say on balance, we're probably going through the 20s. On this one, just because the bounces are very weak. But if we find we get a decent amount of time spent banging off this level, that'll likely change that around and maybe we'll get a break back up. But 20, 25 pips is not a lot. Something's going to happen here. On balance, I think it's going lower, even though I've got separate long down here at 27. It's pretty tight, pretty small. I'm keeping my short position, my core short. But I think maybe on balance we're going to be heading lower. If it goes the other way, fine. I'll take some of my longs off. I've already taken a little bit off this morning, 12 pips, just to put it in the bank. And I'll lock up my stop on the short and see what we want to do thereafter. If we do move up, going to be looking at this 65, 50, 60 area. That's the first resistance area, and then up towards 85.90. Dollar yen, it's had the break. I'm all out of my long-term short position. That one has been busted. I drew the line at 139.50. We've gone through there. What's done is done. I've had enough. I'm not going to give it any more on that one. I still favour this being a decent short, but I'm going to have to pick my time again because we're completely ignoring what's going on with all things Japan. This debt stuff and everything else is taking front seat in all this. Let's get a little bit of a cleaner chart going on here. There we go. So we made the move out of this 138 area. That is still going to be the main support point from me. We're nudging up. We did go above the 50 fib, but we're just sitting on it right at the moment. So are we going to get a clean move above? As you can see there, it's also prior resistance, and it was also a resistant point and a break point going back into last year. So this area is pretty important. If we get a close above there, we're going to be on for 140 most definitely. So for now, you know where you're at. 138 is your main support area, and we're looking at these highs now to see if we hold them or break them. Again, I see no reason why this trend is changing at the moment, but it's going to be interesting to see what happens if we get a resolution to this debt stuff. So the trend is your friend. As you can see there, we might get some support coming in around 138, 80, 90 initially, before anything down towards 138 and a quarter, and then that 138 level from there. Euro sterling, another one that's looking a bit iffy, particularly to the downside. We had that move on the CPI data yesterday, got back into the box, if you like. We're having another move below this 70 area. So to me, it's keeping the bearish pressure on this one. We can't get above that 87, 15, 20 area. This low needs to be watched now around the 49s, 50s. If we get down to there, but we hold it, let's say around 50, 55, that will suggest we may be starting to build a bit of a short-term bottom, because that'll mean the buyers are protecting their buys from this area just a bit higher up, maybe stepping up 55, 60, that sort of area. If we make a new low, even by a few pips, again, I suggest that we're going to be seeing far lower levels on this one. Okay, Gregor, let's get you in, mate. You all ready to rock?
He's unmuted, but I cannot hear him.
Yep.
Yes, I'm here.
Ah,
My mic
There he
was
is.
muted. Yes.
hey,
I'm
wanna
here
take
always
over?
ready. So
Sorry, mate.
I'm here always ready.
Always ready. He's always ready.
excellent.
Do you want to take the screens, mate?
Yep. Okay, so I will firstly start with US dollar. Now, I think that US dollar is still only in a temporary recovery. I know that this, as you all both talked about, US debt ceiling that is driving these prices. And I'm just wondering what will happen with the US dollar when these things will settle down in June. I think that this could actually, if we have current sentiment that is driving this price action, then obviously when these events will be behind us, I think that, again, cycles may change. And if I look back, I still think that the major top for the US dollar has been formed last year, and that we are now just in a corrective phase here. If you look on a big time frame, we are actually stabilizing at this trend line. So obviously we will not see a straight move to the downside, but I think that the US dollar index will remain in this very big channel, but in the next few months or years, we could actually be trading towards the lower side of this channel. But temporary, we are just in the middle of this higher degree bearish trend. And I think that the very strong resistance could be seen anywhere between 105 to 107. So we are closely getting into this area. I'm seeing stocks also coming to the downside this week. So clearly there is some room for more gains. But if Fed, as Stelios mentioned earlier, and other central banks are really going to sooner or later to be on hold, then maybe that's the timing when stocks will find a support and dollar resistance at the same time. So this is what I'm actually looking at, seeing only temporary dollar recovery, but let's say maybe summer will be somehow slow, but then in September, I think that new cycles will kick in. Looking at the Aussie dollar, I still think that there can be some very strong support coming in play. 78.6% FIP and the 61.8% should be levels to watch during this summer. But for now, if we're just trying to focus on these substructures, keep in mind that I'm tracking a free wave drop here. And wave C is an impulsive wave. So this was a corrective wave, obviously, just a pause within ongoing weakness. And wave C, if it's impulsive wave, then should be structured by 5 subwaves. Looking here, looks like that there is not 5 waves down right into the wave C, right? So more weakness, in my opinion, here could be seen. Watch out for maybe some short-term rallies towards 65.60. That was the previous low. Could be a very nice resistance, but clearly trend is down as long as we are trading below this wave to swing high. So for now, Aussie is still trading to the downside. Obviously, it has a lot to do with China, as you said yourself, Ryan. I think you covered dollar Chinese yuan, and even this one looks like that it has some room for more upside. Again, tracking a higher degree free wave recovery. Okay, so for now, if we look closely here, we don't have these 5 subwaves within this wave C, which should be structured by 5 subwaves before we can say that this current impulsive recovery came to an end of the higher degree free wave movement that I'm tracking up from start of the year. So still room for more gains, but I think that 78.6% could be, again, very interesting for limited upside when this current trend will complete. So for now, even this one suggests the dollar strength could resume, and obviously this equals to more weakness on gold, more at least in the short term, and also that stocks could see some more downside. We have a long weekend ahead because there are holidays in Monday in Europe as well. So I think that maybe there will be new sellers on equity showed up, potentially because there's too much risk involved, and this could easily maybe cause some more upside, or at least hold the support for the US dollar. Also, if we look at New Zealand dollar, we've been tracking this one very closely, and looks like it's a very nice ongoing, again, bearish sequence. But keep in mind that maybe things are not so bad as it looks right now here, because again, this is only wave C of the higher degree correction that it's underway since start of the year. Okay, so the most important will be to watch the price action. What will happen when we will have these 5 waves down? That's when I think that, again, market could be at the end of this current very strong bearish cycle, which obviously is making some extensions lower, but again, it's most likely going to be just a correction. Because if you look here on a daily time frame, you can actually see a very nice, beautiful pattern. There's always that markets will not just move straight to the upside and just continue straight higher here after 2022 has ended. So obviously we have some corrective stages. So I think that we are now in a corrective stage, but just searching for the support anywhere around 61.8% would be ideal for this wave C to complete the current seconds. And again, this potentially could happen maybe after summer, looking at these patterns and combination with the time, and also considering that maybe that's later this year, this really Fed will be on hold, and that's when things may change a lot. Also looking at the S&P 500, so looks like that move around 4,200 was a bit overcrowded trade. I mean, everyone expected a massive break higher, so obviously the opposite happened. And normally that's the case when you have this happening in a fifth wave, because it's the final leg of the higher degree impulse, and that's when a lot of traders will become very optimistic. But that's when actually sentiment can shift around, because if something is just overextended, over optimistic, usually the opposite occurs. So I think that we are now in a corrective stage, very big level now. Even if you just ignore the Elliott waves for a second and watch out for the pivot level, I think that for 4070, that's a very big important level, because it's been important here since March. So firstly, it was here a very nice resistance, then we broke higher, it was support. So actually it still can be a support as long as we are above that level. But since we can count completed 5 waves up, I think that we are now in an ABC correction, because impulses, remember, are in 5 waves, corrections are in 3 waves. So I will not turn bullish or look higher for on S&P or on stocks in general until I see this ABC formation to the downside completed. So ideally it could be around 4060, maybe even lower, around 4000, which is obviously also very important psychological level, and the 61.8% as well. Okay, so it's also something that we have to keep in mind on. Also, what I have left here, dollar yen also coming into some ranges here, but still think that 100 and maybe even 42 could be seen. We had some resistance here that was a swing high. You are now at this level, so clearly we are moving into this zone, but since we have this more room for more upside, I think on dollar index, I just assume that even dollar yen will become a little bit stretched to the upside here. The only thing that looks somehow maybe supportive for risk on trades, if the correlations will come back to normal, is maybe the crude oil. We have seen a very nice bounce here, but obviously OPEC and each countries are looking to stabilize the prices, so everyone is fine with the cuts. But so far we are not seeing any major move to the upside just yet. We have seen a retest of the upper channel here, so I think that very important key support still remains around $70 per barrel. So as long as we are above that spike here, that's already obviously a July contract, I think that this trend could resume higher. Because if you look here on this daily chart, I think that we have a very major important key support level here. If you look back, it was important for the last 2 years. Okay, so we really haven't seen any move to the downside, rather just a strong reaction higher. So I think that price will try to stabilize here for this year and maybe just chopping around. But if we break this upper trend line, I think that higher degree correction could actually be in the card. So I still think that at some point, even $90 to $100 per barrel could be seen when this wave B will really start kicking in. Okay, so
you, mate.
Awesome.
Thank you. So that's it from me.
Thank you very much. Thank you very much, Gregor, for popping in and sharing your waves with us. You can see Gregor. What's your Twitter handle, mate? Chuck that in the
Gregor
comments.
Horvat FX.
Yeah.
Gregor Horvat FX. Yeah.
Thank
you. Chuck it in the comments there, mate. If you've got it to hand while we continue, guys and girls can Greggy there. Obviously, come and see him in the chat room as well. Right, just to look at a couple of pairs as well. Kiwi keeping an eye on, as Gregor mentioned there, looking where's the floor. That's probably a question on a lot of your lips. Where's the bottom in the Kiwi? We're carving through the levels. We're carving through the prior support areas, which is never a good sign for when trying to find the bottom. We've got another one coming in. I've got to share my screen, haven't I? So
yep, I was about to say
there.
that.
Yeah. Can you see that all right, mate?
Not yet.
Not yet.
Oh, there you go.
No, it says, yeah, try again. Is it the same bug where you stop sharing and then you can't share again?
Yeah.
We can't see it.
All right, let me just stop sharing.
Do you want me to show something?
Let me just try it one more time. Why does it do that? It's a pain in the butt, I tell you.
Usually when I share, then you can share. So
Go on,
hold on.
you take it.
Let me
and
take
I'll,
that. Let me take that. And now you try taking the screen.
okay.
I can see the screen now.
Yeah, it's mine though. Let's see what if Ryan can share. Yeah. No. Gregor broke it. It's your
Gregor's
fault.
broken it. What you done, Gregor?
Are you sure you have the right screen? Because it says that you are sharing your screen. You have multiple
Yeah, we've
screens.
oh, it's come up. It's come up now. It took a while.
Yeah.
It took a while. Okay. Ryan? Oh, you muted. Ryan asked to unmute. Yeah. It's a
Hello? Hello?
Yeah, hello.
It
Oh,
works.
there we go. Oh, I don't know what's going on there. It's a pain in the butt. It shuts my microphone down when I share the tab, because usually I just share my whole screen.
Oh, wow. Okay.
At least we found a workaround for it anyway. So
Yep.
anyway, talking about the Kiwi, and yeah, Gregor's right. You know, looking for where the support's coming in. We've been through some of the various support levels, so it's not looking too hot. We've got another one, little one round about this area here, 60.5. Really, for me, it's going to be about this fib. You know, if we get down to that fib, it's going to be a big psychological level around about the 6,000. So 60.25 could be a bit of a stall point there. But you know, really, it's all about what the price is doing on this fall down. It's not bouncing at all, and let's stick it on an hour, see that better. So bounces are being limited to the break points so far. We've got this other break point here, so keep an eye on that. If we start to get resistance up against this 60, 86, 60, 90 area, I call it maybe 61, just taking into account those bits there, then it's going to keep the downside pressure in play. So if you've got your butcher's gloves out, as Kay likes to call them, and you're thinking of catching knives, you've got to be careful of your resistance points. You know, highlighted that in Aussie dollar a moment ago. You know, we've had this break in this zone. We found support, but it can't get 25, 30 pips higher. That's always a negative sign if you're looking to catch the knife on these things. So if you are trying to pick the bottoms, make sure you're keeping your stops tight, because if you're wrong, you don't want to be 50, 60 pips offside. You only need to be 10, 15, 20 pips offside to be wrong on those sorts of trades there. Euro CAD, I know some of you guys like to have a look at this one. Not one I trade a lot, but there's a big level here that we've looked at time and time again. You may remember back late last year into this year, the big 46.5 level. Well, we messed around, and now we're holding below it once again. We've had another move up towards it. We are finding support down into the 45s. So you've got 100, 130, 40 pips to play with here. Doesn't matter your bias. You've got two levels. We can't get through 145. We're not getting back above 146.5. So if you want to trade this one, you can trade between the goalposts, shorts into that level, longs into this level, or you can look to go with a potential break of either side. But look for this one to maybe range for a while. As we like to say, always more ways than one to skin a cat on that one. Right, I think we'll. Oh, you want to look at euro dollar? Yeah, let's have a look at euro dollar, Mike, before we shut up shop. So here we are, getting a move. 107. That's my level. We've got down to, where are we? 107.13, 107.14 as the low at the moment. Again, the pressure's still on. We're breaking through the levels. We're breaking through the fibs. This part of the trend is changing. We obviously still have the bigger trend, and I haven't got the fibs on for this yet, but just to give you a rough idea. Let's get it there to there. Ooh. Just roughly. So you see this fib isn't really valid until we're getting way down to here, to near the 105s. So I'm not looking at that just yet. So I'll keep that off my chart for now. But we are breaking down. The pressure is still on, still looking bearish. And then look, this is why the 107 is so big. It's been a former S&R area. It marked that range period that we had between 105 and 107. I will be considering longs down into this on a first test, maybe from about 107.10. I'll maybe scale in some small positions. Again, I won't give it much room. There'll be a stop maybe below just 106.80 on that. But if there's an area where it might bounce, this is the strong level that I like to look at. Been watching for a while, and it'll decide whether this trend is really fully broken, which breaking the 61.8, it looks like it is. But let's see on the longer term whether this one becomes a big level to hold. As for your resistance, pretty clear. 107.60, I traded long off here yesterday, got some pips away up there, knocked out on the rest, and here we are below and finding it as resistance. So that's where your level is, 107, 107.60. Are we going to move in between now? Again, same thing as Euro CAD. If we look to break below 107, then we're heading lower. If we hold here, we need to get above 107.60. So some decent pips for you to play around in there. Again, look for a break up. Break up will take us lightly back to the 108 level on that one. Abir wants to have a quick look at cable. Well, you wouldn't think that everyone's hiked up their rate expectations for the pound, would you, the way this one's going, which again shows you what is the main driver of the pound or of cable at the moment. It's everything that's going on in the dollar. So again, this one's coming. We've had a little test, the 38.2 fib down here, 123.40s, just nicked a little low underneath the fib, but you know, we're not going to call it a hold or we're not going to call it a break for a few pips. As you can see, former resistance area, and now it's showing up as support again. It was support there, a little bit of wishy-washy through here, but it's bounced pretty decent. Where's it got to go to? Well, it needs to get back above 124 for starters, and then 124.50, that old level that we've been watching for a few weeks now. So it's made a bit of a bottom. It's held the fib, give or take, so that's your level. If we come back to this level pretty quickly, you might want to be a bit worried about it. If you're trying to catch the knife here. If you're short, been short from up top, running this trend lower, that's where you want to be thinking maybe about taking profits. But if we do get a quick move back down here, there's a high chance we break, and then we'll be looking at this old fib level around about the big figure on that one. But as you can see, the short-term trend is down. Go with the flow, as we like to say. You're short at the top, Abir. Very nice, mate. Make sure you're taking some profits, please. You don't want to give it all back up, and manage your stops as well behind it. Do you think US GDP later will be a market mover? We've got GDP later, have we? Oh, didn't even know. Probably not, I would say, Mike. Is this another? It's another revision. It's a second estimate. Really, only if there's a big variation is it going to move the market. But the market's pretty much knows what it's getting, and each print we get from GDP has less and less reaction. So really, just look for a big variation. You know, if it goes from the last reading of 1.1%, if it goes to 0.5% or something like that, then we'll get a market move, or if it jumps to 2%. But if it's in around that 1.1%, 1.3, 0.9, something like that, I can't see us getting much of reaction for it. What I would say is keep an eye on the jobless claims coming up later, because it is just starting to edge up a touch. We're not seeing anything close to 300s in the jobless claims, but it is just moving a bit higher, so we'll keep an eye in case that starts jumping up on that one. And I think unless you guys and girls have got anything you want to throw in quickly, we might call that one a day. Thank you, everyone. Thank you to Gregor and Stelios for your contributions today, as always. And thank you to our viewers for coming to the Flow Show and supporting us here.
Thank you, Ryan.
Have a great day all. Cheers, Stel. And we shall see you all tomorrow. Just a quick reminder again, there will be no Flow Show or other ForexAnalytix shows on Monday, because it's a US and pretty much global bank holiday on Monday. And the US bond markets are closing early tomorrow as well. So we should get a quiet Friday. But bear in mind, it will be value date end of month because of that bank holiday. So the F.A.C.E, the London F.A.C.E, 4 p.m. London, could be a bit spicy if everyone wants to get their stuff done before packing up early. Anyway, that's that. Thank you, everybody. See you tomorrow.
Thank you, Ryan. Bye-bye, everybody.
Cheers, mate.